You have $100,000 to invest, but where do you put it? You want high returns, but you also want less risk. You don't have time to trade daily, but you still want your money to work for you. That's exactly why ETFs exist. They allow you to invest in a diversified, expertly managed portfolio without constantly worrying about individual stocks. But with hundreds of ETFs out there, which ones will actually grow your wealth? In this video, I'll break down the 5 best Invesco ETFs. I'll show you and John how much you can grow your investment in each of these funds. And in the end, I'll show you one of my favorite ETFs that'll turn your $100,000 investment into an over $5 million portfolio. Up next, I'll be diving into the top 5 Invesco ETFs, ranking them from great to the absolute best based on their potential to build wealth and maximize returns. Starting at number 5, we have Invesco S&P 500 Revenue ETF with the ticker RWL. This ETF is different from a typical S&P 500 ETF. They do things differently. Instead of weighting companies by market value, they focus on revenue. This means that companies making the most money rather than the biggest in terms of stock price get more weight in the fund. This strategy gives investors exposure to strong companies with solid earnings, making it a smart choice for those who believe in the power of revenue-driven investing. One of the biggest advantages of RWL is that it filters out companies that are overhyped but don't generate strong revenue. Instead, it focuses on businesses that bring in consistent, reliable income, ensuring that investors are backing companies that have real financial strength. So instead of blindly following market capitalization, RWL makes sure that companies earning the most money receive the most weight, ensuring that the portfolio is built on financial strength rather than stock market hype. This ETF is ideal for those who want long-term growth with less risk, as it prioritizes companies with proven revenue generation. While it may not always capture the extreme highs of speculative growth stocks, its steady and disciplined approach ensures consistent returns that compound into massive wealth over time. It has a current dividend yield of 1.36%, backed by a dividend growth rate of 9.91% and an average share price appreciation of 10.09%. Let's look at what happens if John invests $100,000 in RWL. In 1 year, the investment will be valued at $111,450. Fast forward 10 years and the investment nearly triples to $295,375. By the 20-year mark, the portfolio value rises to $870,579. After 30 years, it reaches a staggering $2,560,475, paying $29,673 in annual dividends. What started as a $100,000 investment has turned into millions, in which capital appreciation contributed $2,178,017 and reinvested dividends contributed $282,458. So, the total value added stands at $2,460,475. At number 4, we have Invesco S&P 500 Quality ETF with the ticker SPHQ, an ETF that takes investing a step further by focusing not just on revenue, but on quality. It invests in companies with strong balance sheets, high profitability, and consistent earnings, the type of businesses that don't just survive market downturns, but thrive in the long run. Instead of holding on to struggling companies just because they're part of a major index, SPHQ filters out the weaker performers and focuses only on those with proven financial strength. This makes it a solid choice for investors looking for both growth and stability. One of SPHG's biggest advantages is its ability to weather economic downturns. Prioritizing high-quality companies provides exposure to some of the best businesses in the S&P 500 while avoiding weaker stocks that may drag down performance. Many of the companies in this ETF, like Visa, Meta, and Apple, are industry leaders known for generating strong profits, managing debt wisely, and delivering steady growth over time. SPHQ also delivers on income and growth. It currently offers a 1.11% dividend yield backed by a 7.16% annual dividend growth rate and an average share price appreciation of 11.87%. This balance of income and capital appreciation makes it a strong long-term investment. Its historical performance speaks for itself. A $100,000 investment in SPHQ would grow to $112,980 in the first year, outperforming RWL. After 10 years, the portfolio reaches $332,667. By 20 years, it crosses the $1 million mark at $1,073,261. And by 30 years, it skyrockets to $3,397,527, generating $8,300 in annual dividends. The total value added through compounding is over $3.2 million, with $3,187,469 coming from capital appreciation and $110,057 from reinvested dividends. These are very good returns, and there are even better options coming up next. And in the end, I'll show you one of my favorite ETFs that'll turn your $100,000 investment into an over $5 million portfolio. At number 3, we have Invesco S&P Small Cap Industrials ETF with the ticker PSCI. This fund focuses on small-cap companies in the industrial sector, making it one of the most exciting ETFs for investors looking for high-growth opportunities. Unlike large-cap industrial ETFs that invest in established companies, PSCI targets small-cap stocks, which have the potential to grow at a much faster pace. Small-cap stocks are often overlooked in favor of large, well-known companies, but historically, they've outperformed their larger counterparts over long periods. The reason is simple: smaller companies have more room to grow. While a trillion-dollar industrial giant might see steady, predictable growth, a small-cap industrial company that's just starting to expand its operations can experience explosive gains. PSCI captures this dynamic by investing in a diversified portfolio of high-growth, small-cap industrial companies, ensuring that investors benefit from this powerful trend. Another key advantage of PSCI is its focus on the industrial sector, which is one of the most essential parts of the global economy. Industrial companies are responsible for everything from manufacturing and automation to transportation and construction, meaning they play a critical role in economic expansion. When economies grow, demand for industrial goods and services increases, directly benefiting the companies in PSCI. However, investing in small-cap stocks does come with some risks. These companies are often more sensitive to economic downturns, interest rate changes, and market fluctuations. Because they're still growing, they might not have the same financial stability as large-cap industrial companies. However, for investors willing to embrace higher risk in exchange for higher rewards, PSCI presents a compelling opportunity. It has a current dividend yield of 0.63%, which is expected, as most of the small-cap companies would reinvest the earnings for growth. Still, it has a respectable dividend growth rate of 8.73% and a better-than-average share price appreciation of 12.33%. Based on these metrics, let's see what happens if John invests $100,000 in this ETF. After 1 year, the portfolio will be valued at $112,960. At the 10-year mark, the investment value is projected to reach $335,486. Long-term investors see the biggest rewards after 20 years, where the investment will be valued at $1,109,178. And at the 30-year mark, the portfolio value, thanks to compounding, explodes to $3,630,134. That's an astonishing 3,530% total return, in which capital appreciation contributed $3,448,822 and reinvested dividends contributed $81,312. So the total value added to the portfolio stands at $3,530,134. At number 2, we have Invesco Dorsey Wright Industrials Momentum ETF with the ticker PRN. Momentum investing is one of the most exciting strategies in the stock market. It focuses on buying stocks that are already rising in price and continuing to move higher. This ETF does exactly that. It selects industrial sector stocks that are gaining momentum and holds on to them as they continue to rise. However, momentum investing is not without risks. PRN's strategy works exceptionally well in strong, upward trending markets, but it can also lead to higher volatility during downturns. Because PRN invests in stocks that have already experienced significant price increases, a market reversal could lead to sharp declines. However, PRN's ability to adapt to changing market conditions is one of its biggest strengths. Traditional ETFs that follow an index are forced to hold companies even when they're underperforming. In contrast, PRN regularly rebalances to remove laggards and replace them with stocks showing stronger upward momentum. This active approach allows PRN to take advantage of market trends in real time, ensuring that investors always have exposure to the best-performing stocks in the industrial sector. For investors looking to capture strong, sustained market trends, PRN is one of the best ETFs available. It provides pure momentum exposure to industrial stocks, consistently focusing on the winners while discarding the losers. This makes PRN an ideal investment for those who believe in rising trends, following market strength, and maximizing capital appreciation over the long term. Now let's see what happens if John invests $100,000 in PRN. After 1 year, his portfolio will grow to $113,510. At the 10-year mark, the investment reaches $355,331, showing significant acceleration. By 20 years, the ETF's momentum pushes the portfolio to $1,264,534. But the real magic happens over the long run. At 30 years, PRN delivers one of the strongest performances on the list, reaching an incredible $4,507,376. Breaking it down further, $4,271,003 of this growth comes from capital appreciation, while $136,373 is generated from reinvested dividends, bringing the total added value to $4,407,376. Finally, at number 1, we have Invesco S&P 500 GARP ETF with the ticker SPGP. This ETF is built on the growth at a reasonable price strategy, GARP, which makes it the best pick on our list. Unlike traditional growth funds that chase high-flying stocks regardless of valuation, SPGP carefully selects companies that offer strong growth potential while still being fairly priced. This reduces risk compared to pure growth ETFs while still delivering high returns over time. The combination of capital appreciation and dividend reinvestment makes SPGP a powerful long-term investment option for those looking to maximize wealth. The real advantage of SPGP lies in its balanced approach. It doesn't just focus on fast-growing stocks, but instead finds companies that offer a combination of growth, stability, and value. While other ETFs in this list provide impressive returns, SPGP stands out by maximizing upside potential without overpaying for hype. It proves that smart investing isn't just about chasing trends, it's about picking the right companies and holding them for the long term. SPGP also provides a blend of growth and income with a 1.32% dividend yield, a dividend growth rate of 11.31%, and an average share price appreciation of 13.27%. This combination makes it a powerful tool for long-term wealth building. And the numbers speak for themselves. A $100,000 investment in SPGP starts growing immediately, reaching $114,590 in just 1 year. By the 10-year mark, the portfolio was worth $386,612, nearly quadrupling its original value. At 20 years, it surpasses the $1 million milestone, reaching $1,466,568. But the real power of SPGP comes into play over the long run. By 30 years, the portfolio skyrockets to $5,477,111, paying $35,716 in annual dividends. The total value added to your portfolio will be $5,377,111, with $324,391 coming from reinvested dividends and $5,052,720 generated from capital appreciation. Altogether, SPGP delivers a staggering 5,377% return, making it a top-tier choice for investors who want the best of both worlds, strong growth and reasonable risk. Want to know how to reach a $2 million valuation with only a $10,000 investment? Click the video on the screen to find out.